Welcome back to Investing Talk Podcast.
Today we're looking at IREN.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone tracking infrastructure plays, IREN has become pretty much impossible to ignore.
Right.
This is not just a Bitcoin miner anymore. I mean, it's a company fundamentally trying to shift its core identity.
From that high-stakes crypto exposure to something else.
Exactly, to becoming a heavyweight in AI cloud services. And that transition, the one a lot of companies just talk about, it's actually showing up in their financials.
Okay, let's unpack this then. We're dealing with a huge narrative shift.
Yeah.
So we need to anchor ourselves in the current financial reality.
Of course.
And they are putting up some record numbers. I mean, if you just look at their last 12 months, their trailing 12-month revenue, it's hitting $688.5 million.
Which is substantial growth from their past life.
It really is.
And, the revenue growth is a strong indicator, but what really defines the quality of this pivot is their profitability. Yeah. It just demonstrates incredible operational efficiency.
And what are those numbers looking like?
We're seeing a trailing 12-month net income of $523.26 million. That generates an EPS, an earnings per share, of $1.99.
That net income figure is startling, especially when you factor in the margins.
Yes.
A gross margin of nearly 70% and a net profit margin that's actually over 75%.
Yeah.
I mean, if you were just a pure Bitcoin mining operation, you would dream of margins like that.
You absolutely would.
So how are they maintaining those numbers? It suggests they've completely cracked the code on using energy-efficient data centers.
Precisely. That efficiency is the bull case in a nutshell. It means they're generating far more profit per dollar of infrastructure than, many of their peers.
And when you talk about AI infrastructure, it's all about power costs.
It's the single biggest input. Their ability to keep those costs contained is providing some really powerful operational leverage.
And crucially, the momentum seems to be picking up. We're not seeing stale growth here.
Not at all.
When we look at the sequential growth, Q4 2025 revenues jumped, 29.4% over the quarter before? That's a company hitting the accelerator.
It is. And while the focus is heavily on AI, the core mining business is still expanding, which feeds that infrastructure growth. Their Q1 fiscal 2026 operating hash rate increased 17% sequentially.
So they're expanding fast across the board.
Proving they can scale the underlying assets, yes.
Okay, so if those efficiency numbers are the foundation, the big question is, where does this infrastructure take them? Let's look at what the street is expecting.
Analyst expectations here are aggressive, and that really reflects a strong belief in this AI pivot.
How aggressive?
They're forecasting 2026 revenue growth of 136.3%. To put that into perspective, that is just significantly outpacing the norms for most established tech companies.
And I'm guessing the earnings growth is just as high octane.
Yes. The consensus for earnings per share is looking at average growth of 83.9%.
These aren't just small improvements.
No, these are forecasts reflecting a complete re-rating of the business. You just don't see numbers like this unless the market believes a company has tapped into a scarcity resource and can capitalize on huge demand.
Which takes us right to the competitive advantage. If AI compute is the new gold rush, what's IREN's secret sauce? What's stopping every other hyperscaler from just replicating this?
It all comes down to the most boring, yet most valuable commodity in the country right now, power capacity.
And how much are we talking about?
IREN has secured a staggering 3 gigawatts of power capacity.
3 gigawatts. That is a truly massive figure. For our listener, how do we contextualize that kind of scale?
Well, think of it this way. 3 gigawatts is enough power to run a pretty sizable metropolitan area continuously. Oh. And why this matters so much structurally is that the competition, the big cloud providers, the Googles, the Amazons, they're all hitting bottlenecks.
Right. The interconnect delays and grid constraints we're always hearing about.
Exactly. And community resistance to building new substations. IREN already has the land, the grid connections, and the contracts secured. This gives them a profound structural advantage. They have an inventory of the single most scarce resource.
So that makes them more than just a data center operator. They're almost a power broker.
That's a great way to put it.
They aren't waiting for the utility companies. They are the utility companies for AI compute.
Precisely. This dual identity, what we call the dual mover status, is key. They're still a top, low-cost Bitcoin miner, which provides a resilient base revenue.
But the growth is elsewhere.
But their primary growth vector is rapidly scaling as an AI cloud provider. They are directly targeting that huge compound annual growth rate in AI compute demand, which is projected at 19.4% for the foreseeable future.
The sources also point to vertical integration as another edge. This must be where that power moat meets their day-to-day operations, right?
That's spot on. Sites like Childress and Sweetwater are critical here,
Why is that?
because they enhance margins and provide resilience against energy price spikes. By vertically integrating, by controlling their own power procurement and managing their own substations, they mitigate that cost volatility that other data center hosts have to deal with.
So when utility costs jump, they're insulated.
To a degree, yes. It makes their cost structure far more defensible.
And the ultimate validation of this whole strategy isn't just their internal efficiency, it's who's buying their capacity.
Absolutely.
You don't get a stronger stamp of approval than a nearly $10 billion partnership with a market leader.
That $9.7 billion Microsoft AI deal is just a monumental vote of confidence. It's an exclusive partnership that de-risks their future revenue stream almost immediately.
And there's more.
But even more telling than the contract value is the evidence of scarcity. They hold $1.9 billion in secured customer prepayments. You do not hand over nearly $2 billion in cash before the infrastructure is even fully operational unless you absolutely need that compute capacity and you're terrified of losing your spot in the queue.
So the demand is just unequivocally proven.
Without a doubt.
Okay, so demand is high, growth is projected to be stratospheric, but scaling this fast, building out 3 gigawatts of compute, that requires staggering amounts of capital.
It does.
How are they financing this gigantic expansion without sinking the balance sheet?
They've been incredibly strategic in the capital markets. As of their last filing, they had solid liquidity, holding about $564.5 million in cash and equivalents.
But that's not nearly enough for the full build-out.
No, but the real genius is how they've been raising the rest of the funds.
Tell us about those financing deals. I'm especially interested in the convertible notes.
This is where their financial engineering really shines. They recently secured $1 billion in 0% convertible senior notes due 2031.
0%.
Think about that. They raised $1 billion of debt with a 0% coupon. In an environment with high interest rates, that is dirt cheap financing.
So the market is essentially giving them an interest-free loan.
Pretty much, because it believes the stock is going to appreciate significantly. The conversion price is set high, around $85.63, meaning the stock has to rise substantially before those notes convert to equity and dilute shareholders.
So they're selling the option on future upside, but keeping the immediate cost of capital at zero.
Precisely. In total, they have secured $3.6 billion for this build-out. And despite this, their debt-to-equity ratio is stable at 33.5%, which is quite manageable.
Okay, let's shift to the technical picture. The company is pivoting, the financing is creative, but what's the stock price telling us about market sentiment?
The stock price has been on an absolute tear, which, indicates immense investor enthusiasm. The stock is up over 150% in the last 3 months alone.
So a very strong bullish trend.
This isn't a slow recovery, it's a rapid re-rating driven by that AI narrative.
And technically, the chart supports that long-term bullish view. It's trading well above its key moving averages, right?
Absolutely. The price is currently well above both the 50-day simple moving average, that's around 54.88, and the 200-day average, which sits way lower around 25.27.
When a stock trades at more than double its long-term average, that confirms institutional belief in the uptrend.
It's firmly established, yes.
That indicates powerful momentum. But what about the more contrarian signals? Is the market getting overheated here?
Interestingly, no. Despite that 150% run, some indicators suggest the euphoria hasn't fully set in yet.
Which could be a constructive sign.
It could be. The fear and greed index is relatively low at 39, and the RSI is neutral at 50.40. These neutral readings, against a backdrop of a surging stock, hint that institutional money might be moving faster than retail sentiment.
Suggesting the run might not be exhausted yet.
Potentially.
So big money is accumulating.
Yeah.
What about insider flow? Are the people running the show confirming this bullishness, or are they cashing out?
We are seeing institutional accumulation across the board. Funds are adding to their positions. However, we do have to highlight a bit of a mixed signal here.
Okay.
There was a significant insider sale back in October 2025. A director and co-CEO sold 1 million shares at $33.13.
A million shares is not a small transaction that could be viewed negatively.
It's necessary context, for sure. When a stock explodes like this, some insiders will take profits, often for diversification, but it does raise a flag that needs to be watched.
But the overall institutional accumulation suggests the collective smart money is still on board.
It suggests the long-term thesis is viewed as intact, yes, despite that individual sale.
Let's turn to the near-term catalyst then. What should you be watching for over the next 3 months?
The calendar is packed with critical operational milestones. The first big event is the Q4 preliminary operations update. That's slated for December 10th.
And that will give the market its first real look at the scale of their AI build-out.
Exactly. Investors need to see that they're meeting their promised timelines.
And then we get the full earnings confirmation in the new year.
Yes, the Q3 FY 2026 earnings release, expected around February 7th. This is where the company will either confirm or deny those massive analyst projections.
What about on the ground?
Operationally, watch for the full energization of the Sweetwater substations and confirmation of continued GPU deliveries by the end of Q1 2026. These are the physical proof points that de-risk the story.
We're also hearing a lot of market buzz. Any speculative rumors that could serve as major upside catalysts?
There is persistent speculation about them securing additional multi-billion-dollar GPU cloud contracts extending beyond just the Microsoft deal.
With other hyperscalers.
The rumor mill suggests further strategic partnerships, yes. If they announce even one more contract of that magnitude, given the scarcity of that 3-gigawatt capacity, the stock could re-rate significantly higher almost overnight.
That paints a really compelling bull case. But we have to maintain a balanced view. What are the key points of caution? What's the bear case for IREN?
The first and most critical risk is their lingering exposure to commodity volatility. They might be pivoting to AI, but a chunk of their revenue is still tied to volatile Bitcoin prices.
So a sharp downturn in crypto could still hurt them.
It could dampen financials and funding capabilities, yes.
And managing a 3-gigawatt empire has to be incredibly capital intensive. I assume continuous heavy capex is the biggest operational headache.
It's the unavoidable reality. They need heavy capex to maintain this growth. They have to keep spending to build out the grid and, critically, to procure the newest, most expensive GPUs to stay relevant.
And this intense capital demand leads directly to dilution risk.
It does. That $3.6 billion they raised is strategic, but it comes at a cost to existing shareholders.
How so?
You have two sources of dilution. First, the ongoing at-the-market show issuance, which has already raised $1 billion by selling 66.7 million shares into the market.
And the second?
The potential $2 billion in convertible notes. While the conversion price is high, the overall mechanism presents continuous dilution pressure. If the share price doesn't climb fast enough, the increased share count will weigh on EPS.
And let's revisit those stunning profit margins. Can they really hold those numbers as they scale?
Margin compression is a very real threat. We saw a worrying signal recently. The cost of revenues rose a staggering 52.6% quarter over quarter.
Driven by what?
Primarily by rising utility costs. If energy prices keep trending up, even their vertical integration might not be enough to sustain those near 70% margins.
And if margins erode, the whole valuation thesis changes.
It changes from a high-growth tech player back toward a commodity infrastructure business, which gets a much lower multiple.
So how does the investment community weigh these risks? Does the scarcity of AI compute really mitigate all of this?
For now, it seems so. The consensus suggests that the long-term AI opportunity is the dominant factor. Analyst targets are very high, implying about 54% upside from current levels.
And some are even higher.
Some targets are reaching $136. This tells you the market views the secure power moat as the definitive long-term mitigating factor against all these near-term risks.
So summing all of this up, the entire IREN investment thesis really hinges on one critical dynamic.
It truly does. The success of IREN comes down to whether its secured, massive power capacity allows it to capitalize on the AI pivot faster and more efficiently than legacy cloud providers can close the infrastructure gap.
Can they execute that transition despite the relentless capex and the dilution?
That is the central tension you need to monitor. The crucial question for a long-term holder isn't just the volume of those AI contracts, like that huge Microsoft deal.
It's something more fundamental.
It's margin resilience. It's about whether they can defend that high 70s net profit margin as utility costs rise and GPU prices fluctuate over the next few years.
And if they can,
If they maintain those margins through flawless execution and vertical integration, they become a different animal entirely. If those costs creep up, the story quickly changes.
food for thought for you as you review your portfolio. Make sure you stay tuned for our next analysis. Hit that subscribe button so you don't miss a thing.